The most obvious way for a business to acquire the equipment it needs to run its business is through purchase. No shocker there, right? Well, another way for the business to get that equipment is through leasing. A lease is basically an agreement to pay rent for a specific period of time for the right to use an asset, in this case, a piece of equipment. In a lease agreement, the lessor is the party who owns the asset and is renting it out. The lessee is the party who is paying the rent to use the asset. There are basically two kinds of equipment leases: an operating lease and a capital or financing lease. The main difference to note between the two is the idea of transfer of ownership. In both cases, an asset is being rented. With an operating lease, there is no intention for ownership of the asset to transfer hands at the end of the lease. On the other hand, in a capital or financing lease, the option to take ownership of that asset is intended to transfer hands from the lessor to the lessee at the end of the lease. You think you got all that, hotshot? Let's do some practice to make sure.